everyone, and welcome to our presentation on ESG consideration. My name is Ray, and I'm joined with Ethan, Joseph, Annabella, and Jake. In this presentation, we will be demonstrating why it is appropriate for fiduciaries to consider ESG matters when making investment decisions, and we'll be providing a comprehensive analysis of its impact by looking at the stakes of our thesis, the role of fiduciaries, and the risks associated with ignoring ESG factors, and spending some time into legality implications, and finally, the trends of social investing.
Thank you, Ray. There are three main arguments for why we believe ESG consideration is important while making investment decisions. The first is that by considering all ESG factors, investors are incorporating all risks and variables associated with a company's future performance and therefore stock price. In addition, we believe ESG consideration is appropriate as it is compliant with Department of Labor fiduciary guidelines. It does not violate any state or federal laws and is consistent with fiduciary obligations duty of providing a certain level of care to investors. In addition, we also believe that growing market behavior and growing sentiment around ESG is making ESG too powerful within investing and corporations. Because of this, ESG factors must be included within making investment decisions.
To start, fiduciaries are defined as a person who exercises power on behalf of another, such as making investment decisions on behalf of clients. And fiduciaries have duties to perform in their clients' best interests, maximize their clients' returns, and also minimize the risk for their clients and the decisions that they make.
Asset managers are considering ESG by refurbishing and repurposing their investment portfolios. By repurposing and refurbishing their portfolios, asset managers save costs and maximize returns for their clients. This strategy is being employed by 83% of asset managers, as shown by a recent study. It is an integral part of the fiduciary duty to consider all risks associated with an investment. One of the risks that needs to be considered is government regulation. For example, the Green New Deal and California's future ban on petrol vehicles. As a fiduciary, investing in companies that are compliant with these future and current regulations with their strong ESG propositions is fulfilling their fiduciary obligation to their clients.
And ignoring the consideration of ESG factors can truly lead to a poor reputation of companies, lower viability in the long run, and also potential unexpected large fines.
We will now consider the legality of ESG consideration. Currently, there are three aspects of legislation working to eliminate ESG and ESG investing within fiduciary obligations. The first mandates that fiduciaries and actors who invest on behalf of state agencies can make investments solely to maximize profit. This means investments cannot include aspects such as social impact, only profit maximization. The next is any anti-boycott legislation that has been adopted recently by certain Republican states. This includes limiting government interaction with financial institutions that have boycotted certain industries due to a violation and disagreements over company values. These industries include such as the tobacco industry and certain industrial industries as well. This has actually backfired on the state of Texas, as by no longer interacting with the bank JP Morgan, it has cost its taxpayers $300 to $500 million in extra interest each year, as getting municipal debt has become more expensive due to less options. The last, of course, is ESG discrimination, and this prohibits fiduciaries from excluding certain companies from their portfolio solely based on ESG criteria that does not have any correlation with future financial performance. So what does this mean for ESG consideration? Well, all this legislation and all the state and federal laws, none of which target ESG consideration, only ESG investing. ESG consideration is completely legal as it utilizes ESG matters and risks to uphold and maximize client profits. ESG consideration is not investing, therefore it violates no state and federal laws. In addition, the Department of Labor also upheld that fiduciaries could utilize ESG factors when making investment decisions, stating that it is actually helpful to maximize returns. Thank you.
Furthermore, younger generations are pushing for sustainable investments. As time passes, a higher and higher percentage of active investors are made up of Gen Z and millennials. With this, market views are transforming. Millennials and Gen Z are demanding corporate responsibility for environmental and social issues. And as the environment changes, so is the population. A large majority of Gen Z and millennial investors have exposure to ESG investments already, and many of the younger generations are reporting changing their behavior to reduce impact on the environment. With changed behavior comes changed financial decisions. Around 1/3 of millennials and Gen Z report investing in ESG, and millennials boosted their sustainable investments over 10x from 2015 to 2020. With younger generations taking over, investors need to prioritize the impact of their investments. There's an expected growth of ESG investments of $20 trillion over the next 10 years. 99% of the S&P 500 engages in ESG reporting, and 2/3 of private companies have ESG initiatives. This is not some future mystical investment consideration. This is happening now.
As expected, with the larger millennial and Gen Z populations kind of leading the charge towards a favorable market sentiment in favor of ESG related assets, just 7 years after ESG was officially used in 2004, we see a growth of over 70% in those preceding 8 years, among of which the S&P 500 companies were implementing ESG initiatives at this pace. Following these large caps, we begin to see the smaller market cap companies, such as 65% of the Russell 1000, begin to also initiate sustainability reports. This trend among the US companies was just the catalyst for the next 5 years, which we see a 14% CAGR in all pro ESG related assets under management, an 84% total growth to a net of $57 trillion in ESG related assets under management between just now and 2026. We believe that it would be a violation of one's fiduciary obligation to omit considering such a positive sentiment to an inevitable market trend and turning a blind eye to ESG and ESG considerated relations and investments.
Thank you so much. In addition, like Jake and Annabella said, to ignore current market behavior and sentiment is a violation of fiduciary duty. In addition, we believe it is important to consider ESG matters in investment decisions due to its current legal state, in addition to the overall accuracy and informed investment making decisions it provides fiduciaries. Thank you so much for listening to our presentation, and we look forward to you reviewing our executive summary. Thank you so much.